We will get servicing policy updates from Vice President of Single Family Servicing Portfolio Management, Bill Maguire. I'll hand it over to you, Bill.
Good morning, everyone. It's a pleasure to be here today. Again, I'm Bill Maguire, and I oversee the single family servicing portfolio. My team includes the servicing policy team, the servicer capital markets team, the servicer QC team, and the servicer relationship management team. Today, I will be talking to you about three things. One is an overview of how we provide oversight and manage our servicers. Secondly, I will be giving an update on COVID-19. And then thirdly, as we talked about in past sessions, our servicing reimagined effort. So with that, let's get started. Next slide, please. Okay, first, let's talk a little bit about our servicing oversight. So our teams are in place to provide positive portfolio outcomes, and we're a performance-based team. So how do we do this? We write and implement policies. We oversee our servicers through a relationship management team. We have tools and scorecards of measuring performance of our servicers. We do reviews, operational reviews of our servicers. We, with the help of our core team, we provide regulatory and compliance oversight. And it's all focused on getting good servicing performance and reducing credit losses. We're all about performance and quality servicing. Next slide, please. So who are our servicers? Today, we have over 1,400 active servicers. Over the course of the last month, we've had 23 servicers who were terminated either voluntarily or removed for other reasons. The vast majorities are just small servicers who decided that they no longer wanted to be in the servicing business. What are some of the more recent trends we're seeing? So we continue to see a significant growth in sub-servicing as more and more, I'll call them MSR investors, come to the forefront. They typically provide oversight of the sub-servicers and choose to select sub-servicers versus running their own servicing shop. The size of our sub-servicing portfolio, as you can see, is over $700 billion. It's been over a 50% increase year over year, and it represents just about 32% of our entire portfolio is in sub-servicing. An additional trend we continue to see, and we've seen over the most recent years, is an increasing concentration in our non-bank servicers. It was 30% in 2014. It's up to 43% in 2020. Next slide, please. So let's look at the performance of the portfolio as measured by our SDQ rate, our seriously delinquent rate, which is represents 90-day delinquents, over 90-day delinquents. As you can see, back in the height of the financial crisis, our Freddie Mac SDQ rate, hovered at the end of 2010 at 3.84. Stiffly better than our competition and better than the market overall. As you can see, before the most recent pandemic, we had driven our SDQ rate down to just about 60 basis points at 63 basis points at the end of 2019. Then COVID hit, and you can see at the end of 2020, we had an SDQ rate of 2.64%. That's down from the height in the middle of 2020 of 3.17%. Currently, at the end of Q1, we're at 2.34%, and that continued to come down in April as well. So like I said, our SDQ rate historically has been better than the market and better than our competition, and we continue to see that today. Next slide, please. So talk a little bit about, if we can back up one slide, that would be great. Oh, maybe, well, yes. So let's talk a little bit about how we manage our servicers through the relationship management team. So we have a highly seasoned professional staff of servicing personnel that we've hired over the years to manage and man our relationship team. These folks, prior to pandemic, spent quite a bit of time out in the servicing shops of our servicers, working with them every day in terms of improving performance and creating efficiencies for our servicers and for Freddie Mac. We do this through a number of ways. We have, as I mentioned, the relationship team that's on the ground. We create account plans for every one of our covered servicers that speaks to the portfolio performance and what action steps and plans and goals are we hoping to accomplish with the portfolio at that servicing shop. We have servicing scorecards where we measure key risk performance every month, and we have a process of kind of racking and stacking our servicers to show them how they are performing against their peer group. We do file reviews. We check for prudent servicing practices. We check for appropriate loss mitigation activities. And then we also have a reward program called SHARP, I'll talk to in a second, that we reward our top servicers in their peer groups. And then we work with our core team to do on-site audits of our servicers from a regulatory and compliance perspective. Obviously, over the last year and 3+ months, there's been no on-site core visits, but our core team nevertheless has been performing reviews off-site. Next page, please. I mentioned our reward program. In 2019, we established the SHARP Awards, and we recognized the top 3 servicers by by their peer group, and the peer group is established based on the size of the servicers. So you can see the gold, silver, and bronze winners in each of those categories. First category would be very large servicers. The second category would be kind of your mid-sized servicers, and then the third group would be smaller servicers. And as I mentioned, we produce a monthly scorecard on all 1,400 of our servicers on a monthly basis. Next slide, please. Okay, so hopefully that gave you a pretty good sense of our oversight of our servicers and how we go about driving performance on our portfolio. Let's take a few minutes now to talk about our COVID-19 response. Next slide, please. So here are some of the numbers. We had at its peak, we had over 760,000 loans on forbearance plans, and we hit a peak SDQ rate of 3.17%. One of the more interesting things of that 768,000 loans on forbearance plans, 30 to 40% of those stayed current throughout this cycle of their forbearance plans. As we mentioned, we've driven that 3.17% DQ rate down to 2.34 as of the end of March, and it reduced again in April. So what was kind of our response and our plan of action once the pandemic hit? We, during the course of 2020, issued 14 different COVID-related bulletins. We'll talk about that in a second. It was very clear to us at the beginning, and a key element in managing through this crisis was open and transparent communications with our servicers, and that communication took place as often as possible. So we hosted many seminars and webinars over the course of 2020. And through those webinars, we were able to touch and reach out to over 8,000 attendees. We held 20 servicing advisory board meetings. Our servicing advisory board meeting is made up of our top 15 servicers. We settled 219,000 COVID payment deferrals, and we'll talk about the payment deferrals in a second. And as I mentioned, our QA/QC function, we conducted over 18,000 different file reviews during the course of 2020. Next slide, please. So here's just a further breakdown of our policies related to COVID-19. So it all started back in March of 2020, as you're all aware, and our initial bulletins around offering forbearance to homeowners. Our initial bulletin actually came out before the CARES Act came out, and once the CARES Act came out, we just had to tweak our forbearance policies just a little bit to come in compliance with the CARES Act, and we did so. So then the next step after the forbearance was to come up with what was the solution for loans coming off of forbearance. And we developed and implemented our payment deferral option. And as you're aware, the payment deferral option essentially takes all of the deferred payments from the borrower while on forbearance and tacks it on to the end of the loan. Also in June of 2020, we had our first moratorium extension. And as you can see, there have been several since then. And then, July, September, additional activities around aligning our disaster payment deferral with our forbearance payment deferral, another extension of foreclosure moratorium, and additional updates around our forbearance policies. October to December, again, additional policies related to COVID-19, and another extension of the foreclosure moratorium. And that theme continues in the first quarter of this year, where we had another extension of the foreclosure moratorium now until June 30th of 2021. With each of these foreclosure moratorium extensions, we had to make changes to our forbearance policies to match the foreclosure moratorium, and likewise to the payment deferral expansion. So with that, as you can see, several different times throughout the course of the last year, we had to pivot and react to what was going on in the marketplace, and we successfully did so. Next slide, please. On here, you can just see kind of graphically what we've been speaking about. The blue line here is our early delinquency rate. That represents our 30 and 60-day delinquents. And you can see that capped out just below 5% back in May of 2020. And now it's down to, almost historic lows at 1%. And that, again, represents our 30 and 60-day bucket. It's been, that part of the portfolio has been performing just wonderfully. The red line, again, represents the SDQ. And you can see there, as we reference, we peaked at 3.17% at the end of March, 2.34%, and April, we're down again. Next slide, please. So this slide gives you a view of what what's the workout activity in terms of loans coming off their forbearance plans. As you can see, the orange here represents the payment deferrals. The darker red, as opposed to the orange, represents reinstatements. And then the gray, and very little of this at this point, the gray represents other workouts. As you can see, early on in the pandemic, as loans were coming off of their forbearances, north of 50%, or in that 50% range were full reinstatements of forbearance activities. And that does not include loans that were current and stayed current while on forbearance. As you can see, over time, the mix of loans exiting forbearance has changed to where, we're in the 40% range for reinstatements and 60% in payment deferrals. But again, I think this is a positive that 50% of the delinquent forbearances on average have come through reinstatement and or payoffs. Next slide, please. So what are we doing now? As I mentioned, we found early on that the key to successfully managing through the pandemic was engagement with our servicers. So we continue to have webinars with our servicers. We continue to have small servicer calls. We still continue to have monthly advisory board meetings. We communicate in almost every way you can communicate with our servicers, daily, weekly, monthly, and again, all the information regarding our response to COVID can be found on the Help Starts Here campaign that we've established for our servicers. Next slide, please. So what, if any, emerging risks are continue to be out there around our response to COVID and where we stand today with loans in forbearance? Well, certainly there is uncertainty around what additional actions may be taken by our regulator, FHFA, the CFPB, or the administration. Could there be additional extensions of the foreclosure moratorium? It's possible. The CFPB currently has a proposed rule that's out for comment that essentially would establish a foreclosure moratorium through the end of 2021. We continue to look at our loss mitigation toolkit to see if our solutions will continue to help these borrowers coming out of forbearance. Is the payment deferral continues to be the right solution for the vast majority of these customers? Our Flex mod, which is next in our waterfall, does that need to be tweaked to expand eligibility for borrowers? And then, once the moratorium is lifted, how is the legal and foreclosure process going to be restarted? And do we have concerns around the capacity of the legal system to manage these foreclosures? So these are things we continue to think about, we continue to look at, and we'll make the necessary changes and pivots as it comes along. Next slide, please. So that's our kind of summary of our response to COVID-19. Let me just take a few minutes now to talk about our reimagined servicing program. As you know, this is kind of our years-long journey to inject new technologies into the servicing ecosystem that will drive, certainly, we hope to drive better results for Freddie Mac, create efficiencies in the marketplace for our servicers, and additionally create additional efficiencies within Freddie Mac processing. Next slide, please. So we've talked to this slide in the past, but the whole life cycle, the whole basis behind reimagined servicing is taking a look at the whole servicing life cycle and see where we can interject those new technologies that will improve the customer experience, create efficiencies, bring innovation to the market, and reduce costs. And that's what the reimagined servicing is all about. Next slide, please. So in the past, we talked to you about what we were thinking of and what we were driving towards in the reimagined servicing space. And I'm happy to sit here today and say we've actually have created and implemented a number of key new technologies. The first one I'll touch on is our paid system. The paid system is replacing old technology that is used by servicers to request reimbursement of expenses from Freddie Mac. We launched it in October of 2020 to a handful of early adopters. We did a mid-adopter launch in first quarter of 2021, and broad adoption across all the servicing space will be in third quarter, fourth quarter 2021. The one that we're really excited about is the implementation of our Resolve platform. Our Resolve platform uses API technology that will allow servicers to get decisions right away, real time on modifications. We've rolled it out to a number of early adopters for our flex modification program. More recently, we've expanded that to include the payment deferral, and we launched Decisions Insight, which is a part of Resolve that we use for non-delegated short sales. So we have real live products in the Resolve platform, providing servicers real-time answers to loss mitigation eligibilities. And then last is our Servicing Gateway. The Servicing Gateway was launched in 2019. This is how servicers interact with us, and we just continue to add additional tools to make the servicing of Freddie Mac loans more efficient for our servicers. Next slide, please. So what's the key to this? The key to this is being successful and working not only with our servicers in the implementation of these products, but also working with third-party vendors that our servicers use. So whether it's Back in the Black, and you can see the nice quote here from Pat Coppins, who's the Chief Operating Officer of Back in the Black, but other third parties, whether it's Early Resolution, Black Knight, Sagent, we've developed a process where we're working hand in hand with our servicers partners, as well as our servicers, to bring this technology to the forefront. So far, all the third parties have been very engaged, and they're working wonderfully with us, and we appreciate that. So that is the end of my presentation.